When we talk about the stock market's titans, we often think of tech giants or financial behemoths. But there's another player that has been a cornerstone of the market for decades. Exxon Mobil stands tall, a true giant in the energy world. This company has been a key player in the global energy sector, providing the fuel that powers our cars, planes, and industries. Every time you fill up your car or a plane takes off, Exxon Mobil likely played a part. Their reach extends far and wide, touching various aspects of our daily lives. This isn't a flashy tech startup, it's old school, powerful, and essential to our daily lives. But lately, something's changed. The company is making headlines for reasons beyond its traditional role. Exxon Mobil's stock is surging, catching Wall Street's attention. Investors are buzzing, and financial analysts are taking a closer look. It's like a sleeping giant suddenly sprinting, and investors are taking notice. The sudden surge is not just a fleeting moment, it signifies something more substantial. This isn't just a blip, it's a significant move that hints at a bigger story. The market is reacting to something deeper, something that could reshape the energy landscape. So what's driving this excitement? What factors are contributing to this newfound momentum? That's what we're here to uncover. We'll delve into the numbers, the strategies, and the market conditions that are fueling this rise. We'll break down the numbers, expert opinions, and the energy market's health. We'll explore how Exxon Mobil is positioning itself for future growth. Think of this as your roadmap to understanding Exxon Mobil's recent success. We'll guide you through the complexities of the energy market and the company's strategic moves. We'll make complex ideas simple: earnings, valuations, and market comparisons, so anyone can follow along. Our goal is to make this information accessible and engaging. Let's dive in and see why this energy behemoth is making such big waves. Join us as we explore the resurgence of Exxon Mobil and what it means for the future. Let's dive into the numbers and see what story they tell us about Exxon Mobil's recent performance. Numbers, after all, are more than just figures on a screen. They're a reflection of market sentiment, investor confidence, and the underlying strength of a company. On January 2nd, 2026, Exxon Mobil closed at $122.65, a 1.92% jump in a single day. That's not just a routine uptick, it's a significant move for a company of Exxon's size and reputation. For a massive, stable company, that's a big deal. Such a leap in a single trading session signals that something noteworthy is happening beneath the surface. Now let's put that in perspective. The S&P 500, the benchmark for the broader market, rose just 0.19% on the same day. Exxon's performance wasn't just good, it was exceptional. Exxon outperformed the market by a wide margin, grabbing the attention of analysts and investors alike. Over the past month, XOM climbed 2.73%, while the S&P 500 gained just 0.54%. That's a clear sign of sustained momentum, not just a one-off spike. Even more telling, the overall energy sector actually lost 1.05% during that same period. Most energy companies were struggling, facing headwinds from market uncertainty and shifting global trends. While its peers faltered, Exxon Mobil kept climbing, setting itself apart from the rest of the pack. It's not just outperforming the market, it's outshining its entire sector. This isn't a fluke, it's a trend that's been building over weeks, with Exxon consistently showing resilience and growth. Investors are taking notice, choosing Exxon Mobil over other options, and betting on its brighter future. Their confidence is reflected in the steady inflow of capital and positive sentiment. The numbers don't lie. Exxon's financials are robust, and its performance is setting it apart from the competition in a meaningful way. It's not just about a rising tide lifting all boats. Something unique is happening here, and it's worth a closer look. The market is signaling confidence in Exxon Mobil specifically. Let's dig deeper to uncover what's driving this remarkable performance. So, Exxon Mobil's stock is hot, but what do the experts see ahead? Analysts forecast next quarter's earnings per share at 1.63, a slight 2.4% dip from last year. Revenue, however, is expected to rise to $85.13 billion, up 2.05%. The company is selling more, even if profits dip a bit. For the full year, analysts predict $6.92 per share in earnings, an 11% drop, but revenue should hold steady. So why is the stock surging? Because the market is about expectations, not just raw numbers. Investors may believe the forecasts are too pessimistic. The current price action suggests there's more to the story than just earnings. Let's dig deeper. Why do analyst forecasts matter? Because the stock market runs on expectations. Today's price is a bet on tomorrow's performance. Positive forecasts excite investors and push prices up. Negative ones do the opposite. But the real action happens when results surprise, beating or missing expectations. If Exxon Mobil beats forecasts, the stock could jump. If it misses, it could fall. The recent surge suggests some investors expect a positive surprise. They're betting Exxon Mobil has strengths analysts haven't fully recognized. This tension between forecasts and investor optimism is driving the excitement. The market is always adjusting to new information. Surprises, good or bad, move stocks. That's why these predictions matter so much. Analysts don't just crunch numbers, they give ratings buy, hold, or sell. The Zacks rank, a respected system, currently rates Exxon Mobil as a strong sell. Why? Because analyst earnings estimates have been revised downward by 3.52% in the past month. This signals growing pessimism among experts. Yet, the stock price is soaring, a clear conflict. Investors are bullish, but analysts are waving red flags. It's a classic market showdown, real money versus expert caution. When the market and analysts disagree, it means uncertainty and opportunity. Bulls see hidden value, bears see risk. This battle is at the heart of Exxon Mobil's story right now. Which side will win? Let's talk valuation. How do you know if a stock is cheap or expensive? The price to earnings, PE ratio, is key stock price divided by earnings per share. A lower PE means you get more earnings for your money. Exxon Mobil's forward PE is 17.05. Compare that to its industry peers, averaging just 10.02. That means investors are paying a premium for Exxon's future earnings. Why? They believe Exxon is safer, stronger, or has better growth prospects. This premium price, combined with the stock's surge, shows high investor confidence. But it also raises the stakes. Expectations are sky high. If Exxon doesn't deliver, the stock could fall fast. The PE ratio tells us investors are betting big on Exxon's future. But is that bet justified? Let's look at growth. The PEG ratio adds another layer to stock analysis. It's the price to earnings, or PE, ratio divided by the company's expected earnings growth rate. This formula helps investors look beyond just how expensive a stock is today, and instead, consider how fast the company is expected to grow in the future. By factoring in growth, the PEG ratio gives a more complete picture of whether a stock is truly overvalued or undervalued. A PEG ratio around 1.0 is generally considered fair value, meaning the stock's price matches its growth prospects. If the PEG is below 1.0, it might signal a bargain. Investors could be getting more growth for each dollar they invest. On the other hand, a PEG above 1.0 suggests the stock may be expensive relative to its growth. Take Exxon Mobil for example. Its PEG ratio is a whopping 7.41, which is extremely high by most standards. That's much higher than the industry average of 2.0, making Exxon stand out as an outlier in its sector. This means Exxon is trading at a price that's expensive compared to its expected earnings growth. Investors are paying a premium, even though the company's growth outlook is relatively slow. So why would investors pay so much? It's not for rapid growth. Instead, they might be attracted to Exxon's reputation for stability, its consistent dividend payouts, or its dominant position in the energy sector. These factors can make a stock appealing even if growth is modest. Still, a high PEG ratio is a warning sign. It means expectations are high, but the company's actual growth is lagging behind. This gap can be risky for investors if the company doesn't deliver. It raises a big question: why pay such a steep price for a company that isn't growing quickly? Is there something the market sees that isn't obvious in the numbers? Maybe investors are betting on a future shift in the energy market, or they have strong confidence in Exxon's management to navigate industry changes and deliver value in other ways. Whatever the reason, the PEG ratio reveals that the market is making a bold bet, one that goes beyond just earnings growth. It's a signal that investors believe in something more, whether it's stability, dividends, or future potential. Next, let's see how Exxon stacks up against its industry peers and what that might tell us about its unique position in the market. No company stands alone. Industry context matters. Exxon Mobil's industry, oil and gas, integrated, international, is struggling. The Zacks industry rank puts it in the bottom 7% of all industries. Analysts are lowering forecasts across the sector. Headwinds like low oil prices, rising costs, and clean energy pressures are hitting everyone. Yet Exxon Mobil's stock is outperforming. It's swimming upstream while others sink. Investors believe Exxon is the best house in a bad neighborhood. They're betting its quality and strategy will help it thrive despite industry challenges. That's a bold bet, and it's fueling the current excitement. Let's put it all together. Exxon Mobil's surge is a clash between bullish investors and cautious analysts. Bulls see a giant outperforming its sector, worth a premium price. Bears see falling earnings forecasts, a strong sell rating, and a pricey stock. The industry is struggling, but Exxon is defying the trend. The real story? Investors believe the forecasts are wrong. There's hidden value. Maybe it's global energy demand, oil prices, or Exxon's unique projects. The market and analysts are telling different stories. The future of Exxon's stock depends on which side is right. For now, the battle rages on. Watch closely. This is one of the market's most fascinating showdowns. Booyah.